If you're an investor, you probably know that the 10-year Treasury yield is like the heartbeat of the financial markets. So when it suddenly bounces back above 4%, people pay attention. But why is this number so important, and what's behind the latest surge? Today, we're going to break down what's happening in the $29 trillion Treasury market, why this tug-of-war matters, and what it could mean for your portfolio. Let's start with the basics. The 10-year Treasury yield is essentially the interest rate the U.S. government pays to borrow money for a decade. It's considered one of the safest investments in the world, and it sets the tone for everything from mortgage rates to corporate borrowing costs. When the yield rises, it often signals that investors expect stronger economic growth or higher inflation. When it falls, it usually means the opposite: concerns about a slowing economy or confidence that inflation is under control. Now, this year has been a bit of a roller coaster. Earlier in 2024, the yield actually dropped below 4% for a while, as investors started to bet that the Federal Reserve would soon cut interest rates. Why? Because there were signs that the job market, which has been incredibly strong ever since the pandemic recovery, might be starting to show some cracks. Slower hiring, a slight uptick in unemployment claims, those were enough for some investors to believe the Fed might step in to support the economy by lowering rates. But then, just as quickly, things flipped. The 10-year yield bounced back above 4%, and that's where the real drama begins. Suddenly, the market's mood shifted. New data started to show that inflation, while down from its 2022 peaks, isn't falling as quickly as many had hoped. That's got some investors worried that the Fed's fight against inflation isn't over. If inflation stays sticky, the central bank might have to keep rates higher for longer, or even hike them again. So what's really going on here? Why is there such a tug-of-war in the Treasury market? It comes down to two big camps of investors. On one side, you have the doves, the folks who worry that the economy is slowing down, that cracks in the labor market could widen, and that the Fed will have to act fast to prevent a recession. These investors are buying up treasuries, which pushes yields down because they think rates are headed lower. On the other hand, you've got the hawks, the investors who are more concerned about inflation sticking around. They believe the Fed isn't done yet and that rates might stay higher for longer, so they're selling treasuries, which pushes yields up because they're demanding a bigger reward for the risk of inflation eating away at their returns. Right now, it looks like the hawks have the upper hand, at least for the moment. The 10-year yield popped back above 4%, which sends a pretty clear signal. The market isn't convinced that inflation is completely under control. And that should be a warning sign for investors, because higher yields can ripple through the entire economy. Let's talk about what that means in real life. When Treasury yields go up, borrowing costs across the board tend to rise. Mortgage rates can climb, making it more expensive to buy a home. Corporations have to pay more to issue bonds, which can squeeze their profit margins. Even the federal government faces higher interest costs. Remember, there's $29 trillion worth of treasuries out there. That's a lot of debt, and every uptick in yields means billions more in interest payments. Historically, big moves in the 10-year yield have foreshadowed major shifts in the economy. For example, back in 2006 and 2007, yields shot up before the Great Financial Crisis, as the market started to sense trouble in the housing sector. More recently, in 2022, yields soared as the Fed hiked rates at the fastest pace in decades to tamp down runaway inflation. Each time, those moves sent shockwaves through stocks, bonds, and even the global economy. So what should everyday investors make of all this? First off, volatility in the Treasury market doesn't just matter to Wall Street. It affects your 401k, your mortgage rate, even your credit card payments. If yields keep rising, we could see more pressure on stocks, especially those high-flying tech names that have benefited from low rates. At the same time, bonds, especially long-term ones, could lose value as yields climb. But it's not all doom and gloom. For savers, higher Treasury yields mean better returns on things like CDs, money market accounts, and even short-term government bonds. And if you're a long-term investor, these market swings can actually create opportunities if you're patient and diversified. Looking ahead, the big question is, what will the Fed do next? The central bank is walking a tightrope. If it cuts rates too soon, inflation could flare up again. If it keeps rates too high for too long, it risks tipping the economy into a recession. The data in the coming months, jobs reports, inflation numbers, corporate earnings, will be crucial. And you can bet the market will be watching every signal, every speech, every policy meeting for clues. For now, the bounce in the 10-year yield above 4% is a shot across the bow. It's a reminder that the easy money days of ultra-low interest rates are behind us, at least for now. Investors need to stay nimble, pay attention to the data, and be ready for more ups and downs ahead. If you found this breakdown helpful, make sure to like, comment, and subscribe. I'd love to hear what you think. Are you more worried about inflation or a possible recession? Let's keep the conversation going. And remember, in markets like these, staying informed is your best defense. What happens next in the Treasury market could shape the financial landscape for years to come.